Now we will explore a force quietly reshaping professional performance, investment behavior, and long-term wealth accumulation: dopamine overstimulation within the modern attention economy. This is not a clinical diagnosis. It is a behavioral pattern observable across corporate offices, trading platforms, and digital workspaces. The issue is not that professionals lack intelligence or ambition. It is that their reward systems are being conditioned toward immediacy, and wealth is built through delay. Dopamine's function is not pleasure itself, but motivational signaling. It directs attention toward anticipated rewards. In evolutionary environments, this system helped humans pursue scarce resources. In today's digital infrastructure, however, anticipated rewards are constant and engineered. Smartphone notifications, Slack pings, market alerts, performance dashboards, email refresh cycles, and algorithmic social feeds all operate on variable reward schedules, the same reinforcement structure used in casino slot machines. Major technology platforms openly optimize for engagement duration, which means they optimize for repeated dopamine spikes. The result is not obvious addiction, but recalibrated baseline stimulation. For US-based professionals in tech, finance, consulting, and healthcare, this manifests subtly. The workday becomes fragmented into micro-responses. Slack channels demand real-time presence. Email inboxes refresh compulsively. Portfolio apps are checked repeatedly throughout market hours. News alerts signal volatility. Each interaction provides a small informational reward. The brain adapts. Silence begins to feel unproductive. Depth begins to feel slow. Research in behavioral neuroscience consistently shows that high-frequency reward exposure reduces tolerance for delayed gratification. This has direct implications for wealth. Long-term investing, whether index-based compounding or equity participation, requires emotional neutrality across volatility cycles. Yet the rise of zero-commission trading platforms coincided with dramatic increases in retail trading frequency. During the 2020-2021 retail trading surge, millions of professionals began monitoring markets daily rather than quarterly. Transaction volume rose. Long-term returns often did not. The behavior felt active and informed, yet in many cases it reduced compounding efficiency. The same pattern appears in career development. Deep work, the kind required to produce strategic thinking, intellectual differentiation, or high-leverage expertise, demands uninterrupted cognitive immersion. Yet modern workplace tools reward responsiveness over reflection. Studies on workplace interruption patterns show that knowledge workers are interrupted or self-interrupt roughly every few minutes. Context switching degrades executive function. Strategic thought becomes reactive execution. Professionals remain busy, but long-horizon positioning weakens. Dopamine dysregulation does not eliminate competence. It erodes friction tolerance. Tasks without immediate feedback, writing long-form strategy, building technical mastery, researching capital allocation decisions, feel disproportionately heavy. In contrast, quick reward tasks feel productive. Clearing inboxes, attending rapid meetings, reacting to market updates, these create stimulation loops that mimic progress. Over time, professionals may conflate activity with advancement. Wealth, however, compounds through sustained positioning rather than constant motion. There is also an identity dimension. Many professionals now receive micro-validation through digital metrics: message responses, engagement statistics, performance dashboards, compensation updates. These signals subtly tether self-worth to real-time feedback. When attention becomes externally regulated, internal strategic clarity weakens. The nervous system seeks the next signal rather than sustaining long-form cognition. Historically, wealth concentration has favored individuals capable of operating on extended time horizons. Venture capital funds deploy capital over decade-long cycles. Institutional investors rebalance methodically rather than reactively. Founders endure years of low immediate reward while building asymmetric leverage. In contrast, dopamine-conditioned behavior favors immediacy, frequent checking, short-term decision-making, constant adjustment. The tension between these two time orientations, immediate reward versus delayed compounding, defines much of modern wealth divergence. The cost of overstimulation is rarely dramatic failure. It is gradual dilution. Dilution of attention, dilution of patience, dilution of strategic endurance. A professional may maintain high income, yet fail to transition into higher leverage roles because deep thinking capacity has eroded. An investor may earn respectable returns, yet underperform simple index strategies due to excessive trading. The losses accumulate invisibly across years rather than appearing in a single catastrophic event. Normalization obscures the problem. If everyone checks constantly, constant checking feels responsible. If everyone multitasks, multitasking feels efficient. If everyone monitors markets daily, daily monitoring feels prudent. But normalization does not equal neutrality. Attention is a finite cognitive asset. In an economy increasingly driven by intellectual leverage and capital allocation, fragmented attention carries compounding financial cost. The deeper insight is this: focus is no longer merely a productivity virtue. It is an economic differentiator. In environments engineered for distraction, sustained attention becomes scarce. Scarcity increases value. Professionals who protect cognitive bandwidth gain asymmetric advantage, not by working more hours, but by thinking more coherently within existing hours. Dopamine overstimulation does not destroy wealth abruptly. It slows compounding subtly, and anything that slows compounding, whether capital misallocation or cognitive fragmentation, reshapes financial trajectory over decades. Before optimizing income, investment strategy, or career positioning, one must first stabilize attention. Because in modern professional life, the real asset under threat is not time alone. It is the capacity to direct attention deliberately across long horizons. Next, we begin to understand the structural conflict between the modern reward system and long-term wealth creation. Wealth, by design, compounds slowly before it compounds visibly. Careers, reputations, capital allocation strategies, equity positions, all of them reward sustained patience. Dopamine conditioning, however, prioritizes immediacy. And when the brain becomes trained to expect rapid feedback, long horizon strategy begins to feel psychologically inefficient. This is not theoretical. Behavioral finance research has repeatedly shown that individual investors who trade more frequently tend to underperform those who trade less. The phenomenon is not driven by lack of intelligence, but by overactivity. During periods of high volatility, brokerage app engagement spikes dramatically. Professionals with advanced degrees and stable incomes still feel compelled to monitor daily price movements. The act of checking creates a sense of control and responsiveness. Yet, long-term data consistently demonstrates that excessive reaction reduces compounding efficiency. The brain interprets motion as management. The market rewards restraint. The same short-term bias appears in career behavior. Many professionals optimize for visible quarterly wins, salary increases, lateral role upgrades, high visibility projects, rather than structural positioning that may take years to mature. Equity participation in early-stage ventures, deep specialization in complex domains, or reputation building in niche expertise often requires delayed payoff. In contrast, switching roles for immediate compensation boosts provides instant validation. Dopamine favors the latter. Wealth frequently rewards the former. Modern workplace architecture intensifies this short-term orientation. Performance reviews are often annual. Bonus cycles are quarterly. Metrics are dashboarded in real time. Visibility is tied to responsiveness. When your professional environment rewards immediate output signals, your nervous system adapts accordingly. Deep strategic repositioning, which may not produce measurable feedback for months, begins to feel risky or inefficient. The brain equates delayed recognition with lost momentum. There is also a digital amplification effect. News cycles compress economic narratives into daily urgency. Financial media platforms highlight short-term fluctuations more prominently than decade-long structural trends. Social media accelerates comparison. A peer announces a funding round. Another shares a compensation milestone. Another posts a rapid career pivot. These microsignals trigger comparative dopamine responses. You begin evaluating your own trajectory against highly visible but context-limited updates. The result is pressure to act, adjust, or accelerate, even when your current strategy is sound. Short-term bias reshapes risk perception. Immediate discomfort feels intolerable, while long-term risk feels abstract. For example, reducing lifestyle inflation to increase long-term capital allocation may feel restrictive in the present. Conversely, increasing expenses to match peer lifestyle may feel relieving. The brain prefers immediate relief. Over decades, however, this preference alters wealth trajectory dramatically. The core tension is this: dopamine favors progress signals. Compounding favors patience. When the brain becomes dependent on frequent signals, patience feels like stagnation. Professionals may intellectually endorse long-term investing, yet behaviorally struggle with inaction during volatility. They may understand the value of deep work, yet find themselves repeatedly switching tasks. The friction is neurological before it is strategic. Even productivity systems can become dopamine traps. Constantly optimizing workflows, testing new tools, or tracking performance metrics can feel like advancement, but meta-optimization often replaces actual long-term execution. The professional remains stimulated, but not necessarily progressing structurally. This pattern mirrors frequent trading, high activity, low compounding. The individuals who benefit most from compounding often exhibit unusually high tolerance for boredom. Institutional investors rebalance infrequently. Founders endure long periods without public validation. Senior executives allocate time to strategic thinking rather than constant reaction. These behaviors appear calm externally, but internally they require resisting the pull of immediate feedback. In an overstimulated ecosystem, this resistance becomes increasingly rare. The identity shift required here involves redefining what progress feels like. Instead of associating progress with visible motion, it becomes associated with alignment to long-term architecture. Silence becomes productive. Inactivity during volatility becomes disciplined. Fewer decisions become more strategic. This recalibration reduces dopamine dependency because reward is no longer tied to frequency of action, but to coherence of direction. Short-term thinking rarely ruins wealth overnight. It erodes it gradually through micro-decisions. A portfolio adjustment here, a reactive job change there, a distraction that prevents mastery. Each decision appears minor. Over decades, they shape financial trajectory. Wealth is fundamentally a long-term game played by short-term brains. In an environment engineered to amplify immediate reward, the capacity to operate beyond the present moment becomes a structural advantage. Professionals who stabilize their reward systems gain something more valuable than productivity. They regain time horizon clarity. And time horizon clarity is the foundation upon which durable wealth is built. Now the perspective shifts toward a pattern that feels responsible but often undermines wealth, the illusion of productivity. In overstimulated environments, activity is easily mistaken for advancement. Professionals respond quickly, attend constantly, monitor obsessively, and adjust frequently. The calendar fills, the inbox clears, notifications are addressed, there is movement everywhere, yet structural progress may remain unchanged. Dopamine reinforces visible completion. Each resolved message, each task checked off, each microdecision generates a small reward signal. Over time, the brain begins associating busyness with effectiveness. The professional feels engaged and responsive. However, wealth accumulation, whether through career leverage or capital compounding, is rarely driven by micro-completions. It is driven by concentrated, high-impact decisions executed over extended periods. Consider the difference between clearing an inbox and designing a strategic repositioning. The former provides immediate closure. The latter requires sustained ambiguity tolerance. There is no instant confirmation, no small celebratory signal. Deep strategy work may feel mentally taxing and emotionally unrewarding at first. In dopamine-conditioned systems, this imbalance encourages avoidance. Professionals gravitate toward tasks that feel productive rather than tasks that produce disproportionate long-term return. The modern workplace amplifies this confusion. Many organizations equate responsiveness with value. Slack response time becomes proxy for engagement. Rapid turnaround becomes evidence of competence. Meetings proliferate because coordination feels safer than independent deep work. Yet coordination rarely produces leverage alone. Leverage emerges from clarity built through uninterrupted thinking. This pattern mirrors financial behavior. Frequent portfolio adjustments create a sense of stewardship. Monitoring economic news feels prudent. Yet long-term investing data consistently shows that excessive management often reduces returns. The investor feels productive because action is visible. Compounding, however, rewards patience more than intervention. In both professional and financial domains, visible effort is often overvalued relative to strategic restraint. Another dimension involves optimization addiction. Productivity tools, habit trackers, performance dashboards, these can enhance discipline when used intentionally. but they can also become stimulation loops. Constantly refining systems provides the illusion of control and improvement. The professional becomes manager of processes rather than architect of outcomes. Time is spent perfecting workflows rather than deepening competitive advantage. The economic cost of this illusion is subtle. Income may grow incrementally, promotions may occur, investments may appreciate modestly. Yet exponential shifts, the kind that redefine earning power, require deep focus applied to complex problems over sustained intervals. If attention remains fragmented by micro-rewards, such intervals become rare. Career trajectory stabilizes rather than accelerates. There is also an identity component. Many professionals pride themselves on being dependable and responsive. These are valuable traits, but when identity becomes fused with constant availability, reducing responsiveness can feel irresponsible. Choosing depth over immediacy may appear like disengagement. The professional remains trapped in visible productivity because it confirms worth. Meanwhile, the quieter, more strategic work that generates leverage receives less attention. The individuals who accumulate outsized wealth often appear deceptively calm. They make fewer decisions publicly. They operate with longer feedback cycles. Venture capital firms deploy capital deliberately rather than hourly. Institutional portfolio managers rebalance periodically, not impulsively. Senior executives allocate protected time for strategy rather than constant coordination. Their restraint is not laziness, it is cognitive discipline. The identity shift required here involves redefining productivity itself. Productivity is not the number of tasks completed. It is the degree to which actions align with long-term leverage. When professionals recalibrate their reward systems to value depth over immediacy, behavior begins to change. Notifications are batched rather than answered reflexively. Market checks are scheduled rather than constant. Strategic blocks are protected rather than sacrificed. This shift often feels uncomfortable initially because it reduces dopamine frequency. Silence replaces stimulation. Fewer signals arrive. But over time, the brain adapts downward. Baseline stimulation normalizes. Deep work becomes less aversive. Strategic patience feels less threatening. The illusion of productivity thrives in environments saturated with micro-rewards. Breaking that illusion requires recognizing that visible motion is not synonymous with meaningful advancement. Wealth compounds not through constant engagement, but through concentrated clarity. When professionals learn to distinguish between stimulation and strategy, they regain control over the most valuable economic resource available to them. Sustained attention directed toward leverage rather than noise. Next, we move deeper into a counterintuitive effect of dopamine saturation. It does not only fragment focus, it quietly shrinks ambition. Not in visible ways. Professionals still aim for promotions, higher income, portfolio growth, but the scale of thinking narrows. When the brain becomes conditioned to rapid reward cycles, it begins favoring goals that provide frequent reinforcement over goals that require extended, uncertain commitment. Large ambitions require boredom tolerance. Building intellectual authority in a niche field may take years of quiet work before recognition compounds. Creating scalable assets, equity, intellectual property, network leverage, demands long periods without visible payoff. Writing a substantial body of work, mastering a complex domain, building a reputation that commands asymmetric compensation, these do not provide daily dopamine spikes. They provide delayed amplification. In overstimulated systems, delayed amplification feels psychologically inefficient. The mind unconsciously recalibrates towards shorter arcs. Professionals may pursue incremental salary increases instead of structural equity positions. They may switch roles for immediate compensation bumps rather than endure the slower arc of ownership. They may consume financial content constantly without committing to a disciplined long-term investment framework. The ambition remains present, but it becomes compressed into shorter cycles. There is observable evidence of this compression across industries. The average holding period for public equities has declined dramatically over the past decades compared to earlier eras when investors held positions for years. Career tenure patterns show similar shortening cycles in many sectors, not always for strategic repositioning, but for stimulation and visible progress. In digital environments, content creation, commentary, and micro-visibility often replace long-form mastery. The system rewards frequency over depth, stimulation narrows time horizons, and time horizon defines wealth potential. Compounding requires extended exposure. Leverage multiplies over sustained cycles. When professionals consistently reset their trajectory before compounding matures, they capture incremental gains but forfeit exponential ones. The decision rarely feels like sabotage. It feels adaptive, responsive to opportunity, but beneath it lies reduced tolerance for slow, invisible growth. Another dimension involves cognitive endurance. Extended projects demand sustained mental effort across months or years. Dopamine-conditioned attention struggles with monotony. The professional begins seeking novelty within progress rather than progress itself. New strategies, new tools, new side projects appear more attractive than finishing complex, high-impact commitments. Ambition becomes diversified rather than concentrated. Diversification of attention reduces depth. This pattern also influences financial behavior. During extended market drawdowns, long-term investors must tolerate discomfort without immediate reward. Overstimulated brains seek relief. Selling provides action. Rotating assets provides novelty. Monitoring constantly provides engagement. Yet historically, disciplined inaction during downturns has often preserved or amplified long-term returns. The brain, however, experiences inaction as deprivation when conditioned to stimulation. The identity implications are subtle. If one's sense of momentum depends on visible progress, then slow-building ambitions feel threatening. Professionals may unconsciously redefine ambition downward to maintain consistent reinforcement. Instead of aiming to build enduring platforms, they aim to optimize current roles. Instead of designing multi-decade capital strategies, they focus on short-term gains. The ceiling is not capability, it is stimulation tolerance. The individuals who sustain large-scale ambition often exhibit unusual calm relative to environmental noise. They are not immune to distraction, but they intentionally reduce exposure. They structure their environments to minimize variable reward triggers. They accept long stretches without applause. Their reward system becomes aligned with trajectory rather than immediacy. The identity shift required here involves expanding time horizon awareness. Ambition must be decoupled from constant stimulation. When professionals redefine progress as adherence to long-term architecture rather than daily feedback frequency, ambition regains scale. Fewer projects are pursued, but pursued more deeply. Fewer financial moves are made, but made with greater patience. Stimulation does not eliminate ambition outright. It compresses it. It encourages motion over magnitude. Wealth, however, favors magnitude sustained over time. When professionals regain control over their reward systems, they recover the capacity to think beyond the next quarter, the next market swing, the next visible milestone. And in doing so, they reopen the possibility of ambitions large enough to compound meaningfully across decades rather than cycles. Now the perspective shifts toward an uncomfortable reality. Modern financial markets are not neutral environments for human psychology. They are increasingly designed technologically and commercially to maximize engagement. And engagement often conflicts with wealth preservation. Trading platforms use push notifications for price movements, earnings releases, analyst upgrades, volatility alerts. Financial media headlines emphasize urgency. Surges, crashes, record highs, sudden reversals. Market apps display red and green indicators designed to provoke emotional salience. Even long-term investors are exposed to real-time fluctuations that previous generations would have encountered far less frequently. This matters because dopamine is sensitive to unpredictability. Variable rewards, unpredictable gains or losses, generate stronger reinforcement signals than predictable outcomes. Casinos rely on this principle. Modern trading interfaces mirror it unintentionally or intentionally. When markets move sharply, engagement spikes. Brokerage activity increases during volatility. The professional checking their portfolio during a work break may believe they are being responsible. Neurochemically, they are responding to variable reward stimulation. Behavioral finance research has repeatedly shown that individual investors, especially active ones, tend to underperform broader market benchmarks over long horizons. The reasons are not lack of intelligence or access. They are emotional timing and overreaction. Buying after surges and selling during downturns creates systematic performance drag. The brain seeks relief from uncertainty and excitement from momentum. Markets reward discipline neutrality instead. There is also the illusion of control. Monitoring constantly provides a sense of agency. You feel informed. You feel ready to act. Yet information volume does not equal insight quality. Constant exposure to short-term noise increases perceived volatility even when long-term trajectories remain intact. The more frequently you check, the more dramatic fluctuations appear. This perception amplifies emotional reactivity. Professionals with high incomes are particularly susceptible because they possess disposable capital and cognitive confidence. Access to advanced platforms, options trading, crypto markets, and leveraged instruments creates additional stimulation layers. During periods like the 2020-2021 retail trading surge, participation from educated professionals increased sharply. Social platforms amplified gains, normalized rapid trading, and created visible reward narratives. For some, short-term wins reinforced overconfidence. For many others, long-term compounding suffered quietly after volatility reversed. The financial system increasingly monetizes attention. Brokerage revenue models may depend on transaction volume. Financial media monetizes engagement duration. Social platforms monetize financial commentary traffic. None of these incentives align directly with your long-term compounding goals. The system benefits when you check frequently. Wealth often benefits when you do not. This does not imply markets are adversarial. It means they are stimulating, and overstimulated brains interpret stimulation as opportunity. When dopamine levels are elevated by rapid price swings or trending assets, patience feels costly. Inaction feels negligent. Yet historically, disciplined asset allocation and long holding periods have outperformed reactive behavior for most participants. The identity shift required here involves redefining what financial sophistication looks like. Sophistication is not constant activity. It is emotional regulation under uncertainty. It is the capacity to distinguish signal from stimulation. It is the willingness to let capital compound without daily interference. Professionals who internalize this shift often restructure their exposure intentionally. They reduce notification frequency. They automate investment contributions. They schedule periodic reviews rather than constant monitoring. They separate information consumption from impulsive action. These behaviors are not passive. They are strategically defensive against neurochemical manipulation. Over time, this discipline compounds not only capital, but cognitive stability. Reduced exposure to volatility noise lowers emotional swings. Decision-making improves in other domains as well. Strategic thinking benefits from a calmer baseline. Attention previously fragmented by market alerts becomes available for high-leverage work. The market is designed to capture attention. Wealth is built by directing attention deliberately. When professionals recognize that stimulation and strategy are often misaligned, they begin operating differently. They stop interpreting every price movement as a call to act. They resist the subtle pressure to remain constantly engaged. In doing so, they protect something more valuable than short-term gains. They protect the integrity of their decision-making architecture. And in long-term wealth building, the architecture of decision-making matters more than any single trade, surge, or downturn. Next, we move deeper into how dopamine conditioning reshapes not only investment behavior, but career trajectory itself. In modern professional ecosystems, opportunities are highly visible. Job openings surface daily on digital platforms. Recruiters reach out frequently. Compensation benchmarks are transparent. Peers announce role changes publicly. Each new possibility creates a small reward signal. Novelty combined with upward potential. Over time, professionals may begin to associate career movement with progress itself. Switching roles is not inherently detrimental. Strategic repositioning can accelerate leverage. But when role changes become responses to stimulation rather than structural alignment, compounding weakens. Mastery often requires depth within a domain long enough for reputation, expertise, and network advantage to accumulate. If attention is conditioned toward novelty, patience within a single arc becomes harder to sustain. There is measurable evidence of declining average tenure in certain industries, particularly in technology and high-growth sectors. Some mobility reflects healthy dynamism, yet frequent transitions can reset political capital, delay equity vesting cycles, and interrupt deep skill consolidation. The professional gains incremental salary increases but forfeits nonlinear leverage that often emerges from sustained positioning. Dopamine reinforces visible change. Announcing a new role produces external validation. A compensation jump provides immediate confirmation of upward movement. Remaining in a role to deepen strategic influence rarely produces comparable public signals. Internally, however, the latter may build far greater economic potential. The brain, conditioned to short reward loops, struggles to prioritize invisible growth over visible change. This fragmentation also impacts skill acquisition. Deep specialization demands repetitive engagement with complex material. It involves frustration, ambiguity, and periods where progress feels slow. In contrast, lateral moves into adjacent domains provide novelty and renewed stimulation. Over time, professionals may accumulate broad exposure without deep authority. Income grows steadily, yet the transition to high-leverage positions, partner, principal, equity, stakeholder, remains elusive. Equity is particularly sensitive to time horizon. Many compensation structures reward staying through multi-year vesting schedules. When professionals depart prematurely for modest salary increases, they often sacrifice asymmetric upside. The trade feels rational in the present because immediate reward is tangible. The lost compounding remains hypothetical. Dopamine biases favor tangible gains over probabilistic future windfalls. The same pattern appears in entrepreneurial ambition. Starting projects generates excitement. Launching initiatives triggers reward signals. Sustaining them through slow growth phases requires endurance. Many professionals begin side ventures enthusiastically, but abandon them when novelty fades. The economic impact is not dramatic failure, it is unrealized scale. Another subtle effect involves network capital. Deep relationships compound across years of consistent collaboration. Trust strengthens, influence expands, opportunities flow organically. Frequent switching can interrupt these compounding effects. The professional remains competent everywhere but indispensable nowhere. Dopamine-conditioned movement favors breadth of novelty over depth of integration. This does not imply immobility is superior. It suggests intentionality must override stimulation. The key distinction is whether movement is architectural or reactive. Architectural movement is driven by long-term positioning logic. Reactive movement is driven by short-term validation or novelty seeking. The external behaviors may look similar, the internal drivers differ. Professionals who build substantial wealth often exhibit selective mobility. They move decisively when structural leverage improves, but remain patient when compounding is underway. They tolerate periods where visible progress slows because they understand invisible momentum is building. Their reward system is tied to trajectory rather than change frequency. The identity shift required here involves redefining momentum. Momentum is not constant motion. It is sustained alignment with leverage-building activities. When professionals detach from novelty-driven reward loops, they regain the capacity to stay long enough for compounding of skills, equity, reputation, and influence to mature. Career fragmentation rarely ruins financial prospects immediately. It dilutes leverage gradually. Each reset appears minor. Over decades, the cumulative effect shapes earning ceilings. By stabilizing dopamine-driven switching impulses, professionals protect the most powerful force in wealth creation, time applied consistently within structures capable of multiplying impact. Now the perspective shifts toward the cognitive layer beneath both market behavior and career movement, the erosion of deep thinking. Wealth at higher levels is rarely created through repetitive execution alone. It emerges from judgment, capital allocation decisions, strategic positioning, asymmetric risk evaluation, pattern recognition across complex systems. These cognitive processes require uninterrupted mental bandwidth. Dopamine saturation quietly degrades that bandwidth. Deep thinking is metabolically expensive. It requires sustained attention without immediate reward. It demands holding multiple variables simultaneously, tolerating ambiguity, and resisting premature closure. In contrast, shallow engagement offers quick completion cycles. Checking messages, scanning headlines, responding to updates, these actions generate closure signals. The brain begins preferring low-friction loops over cognitively demanding immersion. Modern workplace research shows that knowledge workers rarely sustain more than short bursts of uninterrupted focus before interruption or self-interruption occurs. Even without external notifications, the urge to check arises internally. That urge is not weakness, it is conditioning. When attention has been trained to expect novelty every few minutes, Sustained concentration feels uncomfortable. The economic cost appears gradually. Professionals may continue producing acceptable output while losing their capacity for strategic depth. They become efficient operators rather than architects. They respond quickly but rarely step back long enough to identify structural leverage. In capital markets, this manifests as reacting to macro headlines rather than analyzing long-term secular trends. In corporate environments, it appears as optimizing quarterly metrics rather than designing durable advantage. Deep thinking is directly correlated with asymmetry detection. The ability to recognize mispriced assets, undervalued opportunities, or emerging structural shifts depends on mental stillness. When attention is fragmented, signals blur into noise. Everything feels urgent. Nothing receives full cognitive integration. Decision-making becomes incremental rather than transformative. There is also a reading dimension. Long-form material, books, research papers, detailed reports, cultivates cognitive endurance. Yet, average attention spans for sustained reading have declined in digital-heavy environments. Professionals may consume large volumes of summarized content while rarely engaging deeply with primary sources. The result is surface-level awareness without differentiated insight. In competitive fields, surface awareness does not create leverage. Executives and investors known for exceptional long-term performance often protect thinking time aggressively. They structure days around uninterrupted blocks. They reduce exposure to reactive channels. They limit real-time information flow. This is not detachment from reality. It is insulation from overstimulation. By lowering dopamine noise, they preserve cognitive depth. The identity shift required here involves reframing boredom as strategic advantage. When professionals learn to tolerate the initial discomfort of sustained focus, they regain access to higher-order reasoning. The reward shifts from micro-completion to conceptual clarity. This shift cannot occur instantly. It requires intentional reduction of variable stimuli and gradual recalibration of baseline attention. As deep thinking capacity returns, career and financial decisions change character. Fewer moves are made, but they carry more weight. Investments are held with conviction grounded in analysis rather than emotion. Strategic risks are taken deliberately rather than impulsively. The professional begins operating at a different cognitive altitude. Dopamine addiction rarely announces itself dramatically. It erodes depth quietly. And in an economy where intellectual leverage increasingly determines income ceilings, erosion of depth directly impacts wealth trajectory. The difference between incremental success and structural wealth often lies in the ability to think longer than others are willing to tolerate. When professionals reclaim deep thinking, they regain access to long horizon advantage. They stop competing on responsiveness and begin competing on insight. And insight, applied consistently over time, compounds far more powerfully than activity alone. Next, we move deeper into the structural reality beneath all of this. Your attention is no longer simply your own resource. It is an economic asset actively competed for. The modern digital ecosystem does not merely distract incidentally. It is engineered to capture, retain, and monetize cognitive bandwidth. And when attention becomes commodified, long-term wealth building becomes more difficult, not because of incompetence, but because of constant extraction. Major technology platforms derive revenue from engagement time. The longer you remain on a feed, the more advertising inventory is served. Algorithmic systems are optimized not for your financial independence, but for your continued interaction. Financial news platforms monetize clicks and session duration. Brokerage apps benefit from trading frequency. Productivity software benefits from subscription dependency. In nearly every case, the incentive structure rewards sustained engagement, not strategic detachment. This creates a quiet conflict of interest. Wealth compounding requires long periods of disengagement from noise. The attention economy requires sustained exposure to stimuli. When professionals check market movements hourly, scroll financial commentary nightly, or monitor peer announcements constantly, they are participating in a system designed to stimulate emotional reaction. Emotional reaction increases engagement. Engagement generates revenue for the platform, not necessarily for the user. There is measurable evidence of this dynamic. Studies in digital behavior show that variable reward notification systems increase daily app opens significantly. Market volatility spikes correlate with trading volume surges. Financial media traffic increases dramatically during downturns and rallies alike. These patterns are predictable because they leverage neurological responses to uncertainty and novelty. The more unpredictable the stimulus, the stronger the engagement loop. The cost is opportunity displacement. Time spent consuming reactive content replaces time available for deep skill development, strategic planning, or thoughtful capital allocation. Even when content appears educational, high-frequency consumption fragments continuity. Professionals may feel informed, yet lack coherent frameworks. Wealth requires integrated understanding, not scattered updates. Another layer involves comparative anxiety. Social platforms amplify visible success signals, funding rounds, exits, compensation milestones, investment wins. These curated highlights trigger competitive dopamine responses. The professional feels compelled to accelerate, adjust, or diversify simply to maintain perceived parity. The attention economy thus converts comparison into engagement and engagement into behavioral influence. Importantly, the system is not malicious. It is optimized for revenue, not for your compounding horizon. If your long-term strategy requires ignoring short-term volatility, but short-term volatility generates the highest engagement, the system will highlight volatility. If slow wealth building lacks dramatic narrative, it will receive less amplification. Your feed will emphasize motion, not patience. The identity shift required here involves recognizing attention as capital. Just as financial capital must be allocated deliberately to generate returns, cognitive capital must be protected intentionally to preserve leverage. Professionals often guard money carefully while allowing attention to scatter freely. Yet, in knowledge-driven economies, attention quality directly influences earning power and investment performance. When attention is treated as scarce capital, behaviors adjust. Notifications are minimized. Information consumption becomes scheduled rather than ambient. Market checks are limited to predefined intervals. Social comparison exposure is reduced. The professional shifts from passive participant in attention markets to active allocator of cognitive resources. Over time, this reallocation compounds. Reduced emotional volatility improves decision stability. Increased deep work strengthens competitive advantage. Fewer reactive career moves preserve structural leverage. Capital compounds more efficiently because behavior stabilizes. The attention economy continues operating, but its influence weakens because participation becomes selective rather than habitual. Wealth divergence in modern professional life is increasingly cognitive before it is financial. Those who allow attention to be continuously monetized sacrifice long-horizon clarity. Those who insulate cognitive bandwidth preserve the conditions required for compounding. The attention economy profits from your present focus. Wealth depends on protecting your future focus. When professionals internalize this distinction, they begin shifting from consumption to control. And in that shift, the trajectory of both career and capital begins to change quietly but materially over time. Now the perspective shifts toward a connection that often goes unnoticed: the relationship between emotional volatility and financial volatility. Markets fluctuate, careers evolve, economic cycles expand and contract. Volatility itself is not new. What has changed is the frequency with which professionals are exposed to it. Continuous exposure amplifies emotional oscillation. Emotional oscillation distorts judgment, and distorted judgment reshapes wealth outcomes. In earlier eras, investors received periodic updates, monthly statements, quarterly reports, annual reviews. Today, real-time price feeds stream continuously. Economic commentary refreshes by the minute. Social platforms amplify dramatic interpretations of every movement. The nervous system, when repeatedly exposed to fluctuations, begins to internalize them as urgent signals. Even minor price changes can trigger physiological stress responses. Behavioral finance research consistently shows that loss aversion, the tendency to feel losses more intensely than equivalent gains, drives many suboptimal decisions. When market downturns are experienced repeatedly through constant monitoring, loss aversion intensifies. Selling becomes emotionally relieving even when strategically detrimental. Conversely, rapid upward movements create euphoria, encouraging risk expansion at precisely the wrong moments. Dopamine plays a central role here. Gains produce reward spikes, losses produce discomfort. Frequent checking increases the number of emotional events experienced. A portfolio that would have seemed stable under quarterly review may appear chaotic under hourly monitoring. The underlying asset performance may be identical. The perceived volatility increases simply because observation frequency increases. This pattern extends beyond investing. In careers, frequent exposure to peer success updates can create perceived underperformance even when trajectory is healthy. Each announcement, a promotion, a funding round, a salary disclosure, acts as a micro-comparison event. The professional may feel temporarily behind, prompting reactive moves. The volatility is social rather than financial, yet its impact on decision-making is similar. Emotional volatility narrows time horizon. When feelings fluctuate rapidly, decisions gravitate toward short-term relief rather than long-term optimization. Selling during downturns provides immediate psychological comfort. Switching roles quickly alleviates comparative anxiety. Increasing consumption reduces status discomfort. Each decision resolves immediate tension but may erode long-term compounding. Institutional investors and experienced executives often structure their exposure intentionally to reduce emotional interference. Portfolio reviews occur at scheduled intervals. Performance metrics are contextualized within multi-year frameworks. Information flow is filtered. This reduces reaction frequency and stabilizes judgment. It is not ignorance. It is risk management at the psychological level. The identity shift required here involves recognizing that emotional regulation is a wealth skill, not in a motivational sense, but in a structural sense. The ability to remain steady during fluctuations directly influences capital allocation decisions, career timing, and strategic persistence. Emotional stability extends time horizon. Extended time horizon increases compounding potential. Professionals who reduce monitoring frequency often report increased clarity. By limiting exposure to noise, they decrease the number of emotional spikes experienced daily. With fewer spikes, decision-making becomes less reactive. Investment strategy becomes more consistent. Career positioning becomes less comparative. The nervous system operates at a calmer baseline. This calm baseline is not passive. It is strategic insulation. It allows analytical reasoning to override reflexive impulse. In financial markets, this often translates into disciplined asset allocation adherence. In careers, it translates into staying long enough for leverage to mature. Emotional volatility rarely destroys wealth in a single dramatic act. It accumulates through small, reactive adjustments. A sale here, a pivot there, a premature exit elsewhere. Each decision individually appears rational within its emotional context. Over decades, these micro-adjustments compound into meaningful divergence from optimal trajectory. Financial volatility is unavoidable. Emotional volatility is partially controllable. By reducing dopamine-driven monitoring and exposure, professionals stabilize their internal environment. That stability becomes an asset in itself. Because in long-term wealth building, the capacity to remain steady while others oscillate often creates disproportionate advantage. Next, we move deeper into a dimension of wealth erosion that rarely feels like erosion at all. Lifestyle inflation, driven not only by income growth, but by stimulation normalization. As earnings increase, professionals naturally expand consumption. This is expected. Yet in overstimulated environments, the threshold for satisfaction rises faster than income alone would justify. Dopamine recalibration does not only affect focus, it affects desire. When baseline stimulation is elevated by constant digital engagement, novelty becomes necessary to feel rewarded. The same mechanism that reduces satisfaction with quiet work can reduce satisfaction with stable lifestyle. What once felt aspirational quickly feels ordinary. The apartment upgrade normalizes. The new car becomes background. The vacation becomes standard. The brain adapts. Reward diminishes. The next upgrade appears subtly justified. This is not mere greed. It is neuroadaptation. Repeated exposure to high-intensity stimuli recalibrates pleasure thresholds. Social media amplifies this recalibration by presenting curated snapshots of elevated lifestyles continuously. Exposure to higher consumption norms increases perceived baseline. The professional may believe their spending reflects earned success, yet part of the motivation may stem from environmental stimulation rather than intrinsic preference. Lifestyle inflation is financially significant because it raises the cost of freedom. Every permanent upgrade increases required baseline income. Mortgage size expands, recurring expenses multiply, fixed commitments rise. The psychological effect is subtle. As income increases, perceived necessity increases alongside it. Financial freedom recedes proportionally. The same short-term bias discussed earlier applies here. Immediate lifestyle upgrades deliver tangible reward. Long-term capital allocation delivers delayed compounding. When dopamine prioritizes immediacy, consumption feels satisfying, while disciplined investing feels abstract. Even high earners can experience constrained net worth growth if reward systems consistently favor present gratification over future leverage. There's also a signaling component. Consumption can function as status communication within professional networks. In environments where success is visible, lifestyle markers reinforce identity. Housing, travel, experiences, and visible assets become subtle indicators of belonging. Dopamine reinforcement intensifies when these signals receive social acknowledgement. The professional begins associating spending with validation. Importantly, lifestyle inflation rarely appears dramatic. It occurs incrementally. A slightly larger home, a more expensive neighborhood, premium services, convenience outsourcing. Each step feels reasonable relative to income growth. Over time, however, flexibility decreases. The individual must maintain a higher income floor to sustain choices made during periods of stimulation-driven optimism. Historically, individuals who accumulate durable wealth often maintain relatively stable lifestyle baselines even as income grows. This is not austerity, it is strategic insulation. By preventing baseline costs from rising proportionally with income, they preserve optionality. The difference compounds across decades. Capital allocated early and consistently benefits from exponential growth. Consumption provides linear satisfaction. The identity shift required here involves redefining what constitutes reward. When professionals decouple lifestyle escalation from emotional reinforcement, spending decisions become more intentional. Instead of upgrading reflexively, they evaluate whether additional consumption meaningfully enhances life quality or merely satisfies temporary novelty. This pause weakens dopamine-driven impulse. Reducing stimulation exposure also lowers desire volatility. When social comparison decreases and digital intensity declines, satisfaction with existing lifestyle often increases. Baseline recalibrates downward gradually. Financial breathing room expands not through deprivation, but through stabilization. Lifestyle inflation does not typically bankrupt high earners. It restricts freedom silently. It converts increased income into increased obligation. The professional appears wealthier externally, yet remains structurally dependent on continued high earnings. Over decades, the difference between restrained inflation and reflexive escalation can define retirement flexibility, investment scale, and generational transfer capacity. Dopamine dysregulation expands desire faster than income compounds. Wealth building requires reversing that ratio, allowing income and capital growth to outpace lifestyle escalation. When professionals regain control over stimulation thresholds, they regain control over financial trajectory. And with that control, freedom becomes structurally attainable rather than perpetually postponed. Now the perspective shifts toward the corrective layer. If dopamine saturation distorts focus, compresses ambition, fragments careers, destabilizes investing, and accelerates lifestyle inflation, then wealth recovery requires rewiring the reward system itself. Not through extreme detox rhetoric or performative discipline, but through gradual recalibration of what feels rewarding. The brain adapts to whatever stimulation baseline it experiences consistently. If notifications, volatility, novelty, and micro-validation dominate daily input, then silence will initially feel uncomfortable. Professionals attempting to reduce digital engagement often misinterpret this discomfort as loss of productivity or relevance. In reality, it is neurological withdrawal from variable reward frequency. The discomfort is temporary, but only if exposure remains reduced long enough for recalibration. Rewiring begins with friction reintroduction. Deep work feels effortful because dopamine spikes are absent. Strategic patience in markets feels boring because real-time feedback is muted. Lifestyle restraint feels restrictive because novelty declines. But friction is not failure. It is recalibration in progress. When the brain relearns to associate satisfaction with completion of meaningful long-cycle tasks rather than micro-rewards, reward pathways gradually realign. Research in habit formation suggests that reducing cue frequency weakens compulsive loops. Scheduling fixed times for portfolio review instead of continuous monitoring lowers emotional volatility. Batching communication windows instead of constant responsiveness restores uninterrupted cognitive space. Removing non-essential notifications reduces reactive triggers. None of these actions eliminate information. They restructure exposure rhythm. Over time, a subtle shift occurs. Professionals begin experiencing reward from clarity rather than stimulation. Completing a multi-hour deep thinking session produces quiet satisfaction. Watching an investment thesis mature over quarters generates confidence rather than impatience. Remaining in a strategically aligned role long enough to build equity produces delayed but amplified reward. The baseline changes. This rewiring has measurable financial consequences. Reduced trading frequency improves long-term investment performance for most individuals. Increased deep work improves skill differentiation and earning leverage. Lower lifestyle inflation preserves capital allocation capacity. Emotional steadiness enhances risk judgment. Each benefit compounds across years. Importantly, rewiring does not require complete withdrawal from modern tools. It requires intentional exposure architecture. The goal is not abstinence, it is sovereignty. Professionals who regain control over reward systems often report heightened clarity across domains. Career decisions feel less urgent. Investment decisions feel less reactive. Consumption decisions feel less comparative. The mind regains long horizon orientation. There is also a leadership dimension. Executives and high-level professionals who demonstrate calm, deliberate pacing often influence organizational rhythm. By modeling reduced reactivity, they create environments more conducive to strategic thinking. Wealth accumulation at scale frequently correlates with this capacity for deliberate pacing rather than frenetic activity. The identity shift here is foundational, from reactive participant in stimulation cycles to intentional architect of attention. When identity incorporates long-horizon patience as a strength rather than a limitation, behavior follows. Boredom tolerance becomes competitive advantage. Silence becomes strategic space. Inaction during volatility becomes disciplined restraint. Rewiring the reward system is not dramatic. It is incremental. A few fewer checks per day, slightly longer focus intervals, a bit less comparison exposure, slightly more capital allocated instead of consumed. Over time, these micro-adjustments restore friction tolerance. Restored friction tolerance restores compounding. Dopamine addiction erodes wealth quietly. Recalibration rebuilds it quietly. The difference between the two trajectories is rarely visible in a single quarter. It becomes visible across decades. When professionals reclaim control over what feels rewarding, and they reclaim control over how time, capital, and cognition are deployed. And those three variables, time, capital, cognition, ultimately determine the architecture of wealth. Now we arrive at the integration point. If dopamine saturation fragments attention, compresses ambition, destabilizes investing, accelerates lifestyle inflation, and erodes deep thinking, then the final realization is simple but structurally powerful. Focus itself has become a wealth multiplier. In an economy engineered for distraction, sustained attention is no longer merely a productivity trait. It is a compounding asset. Wealth in modern professional life is increasingly built through leverage, intellectual leverage, capital leverage, network leverage, technological leverage. All leverage requires clarity, sustained over time. You cannot design asymmetric career positioning while constantly reacting to micro signals. You cannot compound capital efficiently while emotionally oscillating with every fluctuation. You cannot build durable authority while dividing cognitive bandwidth across constant novelty. The individuals who quietly accumulate disproportionate wealth often appear less reactive, not more aggressive. They make fewer visible moves. They consume less noise. They allow investments to mature. They stay long enough for equity to vest. They build expertise deeply enough that scarcity begins to work in their favor. Their advantage is not necessarily superior intelligence. It is superior time horizon control made possible by stable attention. Focus protects time horizon. Time horizon protects compounding. Compounding builds wealth. The chain is direct. When dopamine drives frequent checking, switching, and reacting, time horizon collapses. When time horizon collapses, compounding weakens. The result is not immediate failure, but incremental underperformance relative to potential. Over decades, incremental underperformance becomes structural divergence. This is why the cost of distraction is so misunderstood. It does not usually eliminate income, it caps upside. It keeps professionals in incremental growth patterns rather than exponential ones. It keeps investors active rather than patient. It keeps ambition compressed rather than expansive. Everything appears functional. Nothing compounds maximally. The identity shift required at this stage is subtle but decisive. Instead of identifying as someone who stays informed, busy, and responsive, you begin identifying as someone who protects cognitive capital deliberately. Information consumption becomes strategic rather than habitual. Market engagement becomes scheduled rather than continuous. Career movement becomes architectural rather than novelty-driven. This shift often produces a quieter professional presence. There is less urgency in tone, fewer reactive pivots, more deliberate pauses. Decisions feel heavier but less frequent. Over time, others interpret this steadiness as maturity or executive composure. In reality, it is attentional discipline, and attentional discipline allows higher quality judgment under uncertainty, the core skill underlying wealth at scale. Focus also restores ambition scale. When the brain is no longer dependent on frequent micro-rewards, it can tolerate long arcs of invisible effort. Larger projects become psychologically manageable. Multi-year investment theses feel sustainable. Deep specialization becomes attractive rather than tedious. Ambition expands because the nervous system can sustain delayed gratification again. Importantly, none of this requires extreme isolation from modern systems. It requires boundaries around notifications, around consumption, around monitoring frequency, around comparison exposure. These boundaries protect the one asset that compounds before capital does: attention. Dopamine addiction ruins wealth quietly by shortening horizons. Focus rebuilds wealth quietly by extending them. In a distracted world, sustained attention becomes asymmetric advantage. The professional who can think clearly for longer than peers, wait longer than peers, and resist reacting longer than peers will often accumulate disproportionate outcomes. If this conversation felt uncomfortably familiar, it may be because you recognize fragments of your own patterns within it. The goal here is not discipline for its own sake, but clarity about leverage. Here at Mindful Wealth, we continue examining these quiet psychological forces shaping income, identity, and long-term prosperity. If this perspective resonates, consider subscribing and sharing it with someone who values depth over noise. Because in modern professional life, protecting focus may be one of the most financially intelligent decisions you make.